For me, it's an exciting time as I talk to people. It's anxiety ridden too, because it's about change, right? I mean, people don't like change, but I look at it really high level. People are interested in our markets. There's demand for our markets and our products. We should be blessed and happy that that is the case. And we just have to be resilient and move along with the change. And it's going to be a big positive for our industry.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities, and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here.
Welcome back to Re-engineering Tokenization on Smarter Markets. I'm Dave Greely, Chief Economist at Abax Technologies. Our guest today is Walt Lukken, President and Chief Executive Officer of the FIA and former Acting Chairman of the U.S. Commodity Futures Trading Commission. We'll be discussing the state of the conversation on tokenization in the cleared derivatives industry and what are the next steps towards bringing tokenized assets into the mainstream. Hello, Walt. Welcome back to Smarter Markets.
Hey, Dave, how are you?
I'm doing okay. It's been a busy year, but it's good to have you here to wrap up our series on re-engineering tokenization and, in a way, wrap up this year. I know you've been traveling quite a bit, and you were recently in Singapore for the FIA's Asia Derivatives Conference. Coming off the back of that, how big a part of the conversation has tokenization been this year?
Well, most recently, it's become an enormous part of our conversation. Even a couple weeks before Singapore, we had our Chicago conference where it was predominantly featured on our program. We had Jeremy Allaire from Circle speaking about stablecoins and USDC. And so people are fascinated by the possibility, the vision of what tokenization and stablecoins can do to our markets to make them safer, more transparent. But there's some hurdles we got to get through first. And so while there's excitement, there are devils in the details and there's still some things to do, but it's definitely a prominent part of our discussions right now at FIA.
And I know, as you said, there's opportunities and there's challenges. And what's the current state of the debate on the benefits of incorporating tokenized assets into the traditional derivatives industry?
Well, I think the important thing is, what is it solving for? And I think it's solving for the failings of the public payment system right now that are not open full time. People can't move money on weekends. So it's important that what is it we're trying to solve for? And I think tokenization and stablecoins can offer an opportunity that people can move value at any time to custody those assets in their wallet and have transparency to what is going on with the payment rails. So to me, that's very exciting. For us as an industry, we've struggled when there's been long weekends where markets may be moving, but you're not able to settle those trades. And so that to us is the biggest promise of those assets, is that we may be able to solve this long-standing issue where on holiday weekends, where risk builds up over the weekend because of volatility in the markets, but you can't move money. And so for us, this has great promise to try to solve for that. And we're working with CCPs and others to try to figure out how to do it.
And it's interesting that you referred to some of the deficiencies in the payment system, because that's really outside of the derivatives industry itself. But just the ability to move cash 24/7, is that one of the biggest pieces you see?
Yeah, and this dates back to when we had the Winklevoss twins in 2018. I can't remember the dates when they spoke, and they said one of the driving factors that got them into blockchain and to Bitcoin was the inability to move money 24/7. And they gave the example that it was easier for them to take a suitcase of cash and fly to Singapore. And it was faster for them to do that than to wire the money. And so they saw that as a differentiator for their product. And so I think that has slowly started to sink into the traditional finance markets that we deal with. It's to see how can we use stable coins and other assets to put them on tokens and be able to move them in real time. And it's very exciting.
It is because, as you said, mentioning flying a suitcase of cash to Singapore, it's not just a US market or a European market, it's a global market. And so even the concept of 24/7, it's always business hours somewhere in the world. And so we need to be able to operate as a global industry. And I was curious when you look at this, and there's been a lot of other items on the FIA agenda for years that I think tokenization helps enable. So even things like faster settlement times and moving to T+0. How do you see it helping some of these other challenges or projects that have been in the works for quite some time?
Well, it's really building the foundations to solve for all those projects. And so if we can get this right, then you can start to move money faster. You can de risk the system faster, getting to T0, getting money in the right account faster. So those are all things that we have been working on, but we didn't have the ability because of the public payment rails to achieve those. And we had to do workarounds as a result of this. But this fundamentally changes the game. So if you can move value any time of the day to de risk the system, we can start to think more broadly and also start to grow the industry. The ability to do that, if there's less risk in the system, it means that there's more capacity in the system to take on new trading. For us, it's not just a helping to make sure the markets are safe and sound. That's incredibly important, but it also provides greater capacity for the industry to grow. And this is a great news story for us.
And this summer, you released an FIA white paper titled Accelerating the Velocity of Collateral, the Potential for Tokenization in Cleared Derivatives Markets. And I wanted to ask you, why is improving the movement of collateral so important? And what are the major benefits of tokenization for the movement of collateral?
Our clearing system is based on the fundamental premise that clearinghouses manage the counterparty risk of all its market participants, but that requires us to back trades by collateral. And we've been doing that for many, many years. That actually was one of the lessons of the financial crisis is our markets worked when others didn't. And it was clearing that was at the central aspect of why our markets worked. So this is trying to improve that clearing system even more by allowing the de-risking real time of trades. So as trades happen, we can collect from customers quickly, submit that to clearinghouses, and that just takes risk out of the system as it is happening. What we saw in the financial crisis was risk building up. No one knew where it was. They couldn't see it until catastrophic results occurred. So clearing allows us to be very transparent, to move risk quickly. And by modernizing through tokenization, the back office systems, it's really going to help us to do this even more in real time.
And have you heard any arguments for the risks this could pose to clearing if it's not implemented well?
No, absolutely. And I don't want to overstate how close we are to implementing this. It still is a promise, not necessarily in practice. And part of it is the word stablecoin. How stable is it? And so there have been points of time in the past where dollar stablecoin was not worth a dollar. And so how do we ensure that when you need cash, and that's really what in a default situation, if you're converting stable coins into cash, or if the stable coin itself is the end cash unit, is it going to be stable? Is it going to be a dollar? And right now, dollars are the reserve currency of the world because they do retain value. They're the riskless collateral that the world utilizes. But will stable coins take their place? And I think the Genius Act was passed in the United States. It has to be implemented to ensure that indeed there is dollar for dollar reserves, that those reserves can be accessed quickly. There's accounting of those reserves by regulators. And so that is super important to get implemented. And once we have that in place, people start to utilize this more. There's going to be more reliance on this. So we don't actually see this as a wholesale change happening very quickly, but something that starts to get implemented transitionally over time as people get more comfortable with it.
I think many of us remember during the financial crisis when some money market funds broke the buck, and none of us want to repeat that. So, do you see stable coins as ultimately being backed dollar for dollar?
Well, I think that is the requirement of the Genius Act, is my understanding. And so, whether it's treasuries or dollars, whatever, but it's meant to have assets sitting behind it. Unlike dollars, though, stablecoins do have some counterparty risk to it. They have an issuer, and let's say something happens to one of these issuers, or a reputational issue of fraud of the CEO or something. You could see people starting to, exit and a bank run on that digital currency. And so we have to sort of solve for those things. Again, how do we keep stablecoins stable? And there's probably ways, these are solvable things. And some of it's just going to be people utilizing the asset and getting comfortable with it. But we just have to be aware, just like money market funds, and we put in reforms after it broke the buck. The prime fund broke the buck, financial crisis. And so we're trying to make sure that that does not occur for these types of new stable coins. And it seems to me that people are trying to solve for it.
Switching from the stable coin side to more of the collateral side, what assets do you think will be the first to have tokenized versions used for collateral at clearinghouses?
Well, money markets have been mentioned as one because of the fact that they are very stable. There are these reforms. And so I think right now, for initial margin, there's a variety of types of collateral you can hold. Oftentimes, that collateral, including US Treasuries, are haircutted. So we discount for if you want $1 of value in IM, you have to hold $1.03 of treasuries in order to cover that. And so I think there are ways for us to use tokenized assets in small percentages with possible haircuts as we start to transition them as acceptable collateral for margining. So to me, deposits and money market funds are the likely ones that are most stable, most accepted, and probably are the first in line to be tokenized.
And you brought up a really important topic, which is the haircuts, because often we began this conversation talking about 24/7 clearing, moving to shorter settlement times, and that, as well as convenience, it comes down to money, because if you don't have to be shut for the weekend, if you don't have to be shut for the evening, you can have smaller haircuts applied to many of these assets. How big a focus is that for market participants?
I think it is. I mean, it's certainly one of the issues I think we've noted needs to get resolved. I think Jeff Sprecher, who I interviewed from the CEO of ICE, he said, it doesn't make sense to me that treasuries are haircutted in a clearinghouse, but stable coins that are backed by treasuries are not haircutted. It's clearinghouse. And so I do think there has to be an honest assessment. And really, haircutting should be based on data. It should be on stressed markets events. How did that asset behave in stressed market events? Did it lose value? Did it not? And so those are things that hopefully we can start to find a international standard around how much we should haircut these instruments and try to get the right amount, because ultimately we're trying to make sure that in a time of crisis, as everybody is running for cash, that the cash is there, dollar for dollar, the cash is there. And so we want to be conservative about this. And so hopefully regulators take a bit of a conservative approach here and base it on data. And I think over time we will get there.
And I'm curious, in your conversations, how much enthusiasm is there amongst clearinghouses and their regulators to use tokenized assets as collateral?
I think there's excitement. I think, like anything, people are always hesitant to change if the current systems are working. So this is change, and sometimes you got to push people along. I think our view is it's going to be better for the market. So it's going to be a concerted effort of regulators helping to push for this and to remove impediments. But ultimately, it's the market that has to demand this. And I think there is some demand here. And I think CCPs are looking to experiment in this area. Like I see, as we head into 2026, there's a lot of people we've surveyed. What do you think it's going to happen in 2026 or beyond 2026? I think we'll get some really healthy experimenting going on in 2026. I don't think we'll be there totally. I think that's a closer to a 3 to 5 year period of time for us. But I think you'll really start to get practical experiments happening among CCPs. And as people get comfortable with it, I think you'll start to see more adoption among the industry.
And are there certain questions regulators have been raising or things they would like to see come out of these experiments to give them comfort?
I think they're learning like all of us are learning about this. I think part of their role is, and the CFTC just issued some guidance around this. Should it be acceptable collateral? And so there are legal impediments that have to get clarified and resolved to make sure that you can start to accept these things as acceptable collateral on clearinghouses. So regulatory agencies from the US, the CFTC and SEC, but you have MAS in Singapore that's been very forward thinking on this. They have Project Bloom, which is a project that they allow experimentation of industry people in a regulatory sandbox. So the rules can be exempted for certain activity. You have BIS, the Bank of International Settlements, doing a project, Project Agora, on this. UK is very active on this. And so for me, the regulators are learning. I think they seem open to understanding it and allowing some participation and small pilot projects. But I have not heard anybody say this is not a no go. I think there is some openness right now among the policy community because they see this as the future.
And I'd like to dig a little deeper into the collateral issue. Clearinghouses, there's the distinction between initial margin and variation margin, with variation margin still largely requiring cash for the most part, while many more types of assets qualify for use as initial margin. What do you see as the challenge to bring tokenized assets for use in each form of margin?
Yeah, I think IAM initial margin is probably the first to accept and to utilize tokens. And again, because right now IAM does accept various forms of collateral, and each clearinghouse is different, but they tend to say, we're willing to accept cash, treasuries, but other types of assets that are discounted are haircutted in order to accept it and at a smaller percentage. And so I think there is room, obviously, in that type of diversified portfolio set to allow these new products to start to happen. I think variation margin is more difficult because, as we talked about earlier, it's a pass through. So variation margin is just the losers paying the winners the money from each day's market moves. And so that has to be dollar for dollar cash right now. And if you substitute in a representation of cash, then that gets a little trickier. Is it going to be a dollar for a dollar? And do we want to do that or not? And so I think that's again, down the road a bit more as this becomes more accepted tender as we head down, 3 to 5 years from now, that there may be more willingness to go to variation margin and using tokens. But right now, again, if it's not broken, don't fix it. And I think people are happy with cash and don't really necessarily see the advantages of moving to a tokenized asset at this point.
And how big of a challenge is it in that trying to bring change to an industry with global participants, but with exchanges and clearinghouses that are locally regulated? It would seem like you might have a bit of an all or nothing, right? If one jurisdiction approves it, but others don't, it could make it difficult in a global environment. How do you think about that, maybe with your former acting chair of the CFTC hat on?
Even our paper, we try to go to first principles of how this should look. And what types of regulations should be a part of this project. But I think international standard setting is important. So IOSCO can be helpful in ensuring that the principles of how tokenized assets should move forward. They can help to set those principles and how regulators approach it. But I do think right now, the markets are moving so fast. The CFTC has been very aggressive in providing guidance and encouraging the use of these tokenized assets. I think Europe and Asia have been a bit more cautious about it. But like anything in the world, competition drives change. And so other regulators that see one regulator moving forward, they can either move forward with them or decide not to, but that may come at a cost. And so I think regulators, this is certainly not a race to the bottom because I think this is a blank piece of paper. I think regulators are trying to figure out what is the smart regulation, the right regulation of these products, but allowing these tokens to, I think the US moving into this space is likely to cause Europeans and Asians to move faster into this space and to try to sort of keep pace with allowing these assets going forward.
And is there any analog in your memory of the industry and the markets to bringing in a new product or new way of doing things, the way tokenization could represent?
That's a really good question. I'm trying to think through. I think in many ways, electronic trading was one of those things where it just, once it happened in significant. Everybody moved to electronic trading over a period of time, and it ultimately led into the death of pit trading globally. I see where once this takes off, you're going to start to see great reforms among exchanges globally to try to keep pace. So I don't know if there's a one for one analogy here that I can remember. But to me, that was, the move from physical trading pits to electronic trading is probably the closest analogy I can think of.
And you've mentioned a couple of times in this conversation that this isn't something that's going to happen overnight. And I was curious how much work needs to be done on the legal and the regulatory side to bring these tokenized assets into the mainstream of the cleared derivatives industry.
Well, I think one of the big things is just implementing the Genius Act that was just passed in the United States and other jurisdictions. I think Europe has MICA and making sure that the sort of fundamental base regulatory system is in place for stable coins and tokenized assets. And so that will take a year to get into place, and the prudential regulators have to get all those rules out for comment. And that will be helpful because that's going to bring credibility to those products. I think the secondary thing will then be the market regulators will have to look at their rules and regulations. For example, there's a rule in the CFTC's rule book, Regulation 1.25, that regulates the types of collateral that is acceptable for margining and for FCMs to hold. And that mainly is around liquid, stable assets. And so they'll have to look at that. I think our view is there doesn't need to be significant changes in the CFTC rules in order to accept this, that it's flexible enough in a principles-based regulatory regime to allow the underlying technology of what tokenization brings is as acceptable collateral. So in this paper we did over the summer, we have a legal analysis as part of the appendice that sort of goes into some of that we don't see major changes needed. There may be guidance needed and other things. So those will be the two things, getting the prudential regulators to regulate the product, but then getting the market regulators to look at their regulations. But on the market side, I don't see as much of a heavy lift as on just the prudential regulatory side.
And you mentioned earlier that you could see this bringing more transparency to a lot of operations. Are there some other things you're looking at when you see this movement towards tokenization that could de-risk markets and actually make them more straightforward to regulate?
Well, I think there are lots of applications because this is moving assets to DLT, to a ledger. There's still lots of applications that can be built on that. I think at first people were nervous that DLT meant that you can't see these the audit trail of all these trades and where the assets are. And I actually think it's quite the opposite. And as we get smarter on these things and we can develop smart contracts, things like right now, trades happen and then manual systems capture those trades. And we have to report those trades to the regulators and we got to report the positions to certain people. And we're doing this globally. But just think if a trade happens and it's a smart contract and you plug into that trade, report here and file here, and this could be automating things in the future that we just haven't even contemplated. And you could take significant costs out of the system if we can do this right. So I think the fundamental technology of DLT, blockchain, is going to really change what we do, how we do it, and as an industry. And we're just starting to scratch the surface. But first, we got to build the rails. Once we do that, we can start to build the apps on top of it.
And you mentioned that you've been on the road quite a lot over the past month or two, FIA Chicago, then the conference in Singapore, and I'm sure quite a few others. On a personal level, is there any conversations you've heard or approaches you've seen that have gotten you the most excited?
One of the companies that we have been briefed on is DTCC is doing some interesting things on tokenization, and they seem pretty advanced on the topic. And I know NASDAQ announced at our Boca conference this year that they're moving to 24/5 trading in 2 years, so it's still a ways off, but they're working with DTCC to figure that out. And so for me, the excitement is like the collaborative energy of growth. I mean, because this represents growth in our markets. For years, for a decade plus, we've been talking about the rules and regulations post financial crisis. And now is a time where, like, okay, let's figure out how we can safely grow our markets using new technology that provides more access to people globally. And we're seeing an explosion in our markets around the world. For me, it's an exciting time as I talk to people. It's anxiety ridden too, because it's about change, right? I mean, people don't like change, but I look at it really high level. People are interested in our markets. There's demand for our markets and our products. We should be blessed and happy that that is the case. And we just have to be resilient and move along with the change. And it's going to be a big positive for our industry.
And you've been a big proponent and supporter of innovation and growth in these markets. As you said, not everybody enjoys change. It can be painful. And also, it brings a lot of new people into the markets. How much are you seeing, like, even the makeup of the FIA changing in recent years as there's been more technology and tokenization efforts brought in?
I do see it. And over the years, we worried that our industry was aging, that it was not bringing in a youth generation. How do we do that? How do we get people excited about our industry? Here it is. Like, we're starting, like at our Asia conference, we saw a lot of young people who are interested in our markets, are interested in these new platforms that are happening. And they think differently about money than our generation thinks about money. And we should embrace that. And it's not that we're throwing away the lessons and the infrastructure of our generation. There's a lot of value there and good things that we have built over time, but we also shouldn't dismiss these new markets, this evolution, this innovation, as you say. To me, that's the exciting, that's the energy that our industry should be embracing. And it's going to be a wonderful, innovative 2026 as we head into the new year.
Thanks again to Walt Lukken, President and CEO of the FIA, and former acting chairman of the U.S. Commodity Futures Trading Commission. We hope you enjoyed the episode. This concludes our series, Re-engineering Tokenization. We'll be back next week with our end-of-year holiday special episodes. We hope you'll join us.
This episode is brought to you in part by Abax Exchange, bringing better price discovery and risk management tools to navigate today's commodities markets through centrally cleared, physically deliverable futures contracts in energy, environmental, battery materials, and precious metals markets. Smarter Markets are here. Contact sales at abax.exchange to get started. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.